In this flipped classroom presentation, students will learn about financial planning and financial statements that companies use to monitor the growth of their business. First, we'll discuss financial planning and the budgets and records used to help monitor the success of a business. A budget is simply a plan for your financial needs. An individual uses a budget to monitor their personal income. A business uses their budget to monitor their income, called revenue. No matter what the label is on every budget, you'll have sources of income and amounts of expenses. Your income can be anticipated over periods of time. Your expenses are predicted based on past history. For businesses that are not brand new, managers can use previous budgets to create new ones for the upcoming month, quarter, or year. New businesses, on the other hand, have to be more opportunistic and use resources like the Small Business Administration, tap into other small businesses willing to help, or look at industry publications as a guide. A single-use startup budget is used at the beginning of a business or during a major expansion. Startup budgets can include anything that a business deems necessary to begin their operations. This includes the building or rent, equipment, inventory, supplies, and opening payroll, to name a few. An operating budget looks more like a budget that an individual might use to monitor their personal income. It's used ongoing for day-to-day activities and to monitor expenses. Operating budgets are done for 3-month periods, 6-month periods, or 1-year periods. An operations budget includes revenues, or the income that a business receives, expenses, which are the cost to run the business, and at the end, a comparison of the two generates either a net profit or net loss. A cash budget is an estimate of the actual money coming in or going out. This simply means that money is not being borrowed or it's not going to be repaid later. Cash helps pay for expenses and salaries during operations, and it can lead to investment opportunities when excess cash is available at the end of the period. Financial records are used to record and analyze the financial performance of a business. They provide detailed information about the financial activities of the company. An asset is simply an item of value that is physical or tangible. An asset record identifies the buildings and equipment owned by the business, their original and current values, and the amount owed if money was borrowed to purchase the assets. Over time, an asset loses its value. This is called depreciation. A depreciation record identifies the amount assets have decreased in value due to their age and their use. Depreciation affects nearly every physical asset of a business. An inventory record identifies the type and quantity of resources and products on hand, along with the current value of each. Accounts payable identifies purchases that were made using credit and have yet to be paid. Oftentimes, businesses buy items and then pay for them over time. Accounts receivable is just the opposite. It identifies customers that have made purchases using credit and the status of their account. A cash record lists all cash received and spent by the business. And once again, cash simply refers to the amount of money actually being used, not money being borrowed. A payroll record contains information about compensation and benefits for all of the employees of the company. Tax records show all taxes collected, owed, and paid as part of the payroll system, sales tax, and taxes paid on income and the value of a company's assets. Standard 3.4 looks at common financial records and statements, as well as financial ratios companies use to monitor the success of their business. One of two statements that every company uses is called a balance sheet. A balance sheet looks at the assets, liabilities, and owner's equity for the business on a specific date. As previously discussed, assets are things of value. Liabilities, on the other hand, are debts that you owe, and owner's equity can be described as the value of the owner's investment, or the amount of money put into the business. When comparing these three on the balance sheet, assets should always equal the liabilities plus the owner's equity. This is also known as the fundamental accounting equation. An income statement is sometimes called a P&L, or profit and loss statement. These statements include revenues, expenses, and you guessed it, profits and losses, and are recorded over a period of time. A simple way to think about profits and losses are when you make more money than you spend, you earn a profit, and when you spend more than you make, you suffer a loss. The following financial ratios indicate how well the business is performing in key areas. The current ratio identifies if a business can pay its debts. To find this, take your current assets and divide it by your current liabilities. Ideally, a company owns more than it owes to somebody else. When using the term current in accounting or financial perspectives, this refers to a record being paid or collected within one calendar year. The debt-to-equity ratio identifies how reliant a business is on money borrowed from others. To find this, take total liabilities and divide it by owner's equity. Most banks want to see a debt-to-equity ratio of about 1-to-1, but no higher than 2-to-1. The net income ratio identifies how much profit is being made from every dollar of sales and can be figured by taking total sales and dividing it by net income.